I think diversification is more important than ever because sequence of return risk is such a big risk for you, right? If you're done saving and you're living off of your investments and you don't have as much income or time to wait out a bear market anymore. So that's when I think diversification matters even more than usual because you want to have these different streams of returns in case one of them goes wrong. Japan was the biggest stock market in the world in 1989, even bigger than the United States. And it went from 45% of the global market cap to 5%. And the rest of the world moved on just fine and didn't really bat an eye. And so that's the kind of thinking, that's why you want to have a more diversified portfolio, why I'm a big proponent of international investing. There are a lot of investors right now who think, what are you guys talking about? This is easy. Just put all your money in the S&P 500 or the NASDAQ 100. This is the only thing you need because this is the only thing that's working. And in a bull market, diversification does make you feel like an idiot, right? You go, why am I doing this? Why do I have these other pieces of my portfolio that aren't keeping up? I should have all my money in tech stocks. What are we doing here? The reason you do is because these things are cyclical.
Welcome to Catching Up to Fi, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to Fi together.
Hello, and welcome back to Catching Up to Fi. I'm Bill Yah with Jackie Cummins-Koski, and today we have a market historian and psychologist with us in the house. Are you aware that you might be suffering from a little never-ending bull market recency bias? Do you know what a lost decade in the market really feels like? How about a lost 3.5 decades? Is risk really worth the reward?
Yeah, welcome back to Catching Up to Fi. Today, we are joined by Ben Carlson, and you may know him better from the blog, A Wealth of Common Sense. He has a new book called Risk and Reward, and we are just thrilled that he is joining us today. Now, Bill, I know you have done a deep dive into Ben Carlson.
Yeah, for many of us in the, dare I say, older catching up community, the fear of market cycles, bubbles, Great Depressions, financial crises, and lost decades can sometimes feel paralyzing, or maybe we've forgotten about them and need to remember them. Ben has a unique ability to use data and market history to stress test his belief in long-term buy and hold investing in a simple way.
Yeah, he demonstrates while markets are often unpredictable and full of surprises, he understands historical trends and he can help us provide his valuable perspective on the show today.
Yeah, his work shows that long-term investors who manage their behavior and stay disciplined are almost always rewarded over time. Let's get into some animal spirits, his podcast. So Ben, welcome to Catching Up to Fi.
Glad to be here, guys.
All right, so you provide great perspective, a la William Bernstein, a la Warren Buffett, with your incredible knowledge of market history. But you use great anecdotes, analogies, even sports analogies in the book to describe certain things that every investor needs to look at. One of my favorite stories or thought experiments that you used both in one of your famous blog articles and then fleshed out even further in your book is what about our friend, the investor Bob, the world's worst market timer or best market timer, as you put out in your book. Can you tell us about Bob and take us through this thought experiment? Because people think, oh no, I just got to buy the dip or buy the peak or buy the trough. And Bob tells us that in the end, dollar cost averaging is our best friend. Take us through that thought experiment, please.
Yeah, it's funny. I think everyone wants to be able to perfectly time the market in some ways and put all your money in at the bottom and get out of the top and sidestep right before things get bad. And on my 20 years of doing this, I've yet to find anyone who can do that consistently, right? It's really hard to do. It really toys with your emotions. And so back in 2014, we had just started getting back to new all-time highs from the Great Financial Crisis. It had been since 2007. So it had been a long time in between highs because we had that huge crash. And I remember when the new highs were hit again, it wasn't like people were celebrating. People were going, oh no, what if this is the last time this happened and we have a huge crash again and we have a really painful period? And so I said, okay, fine, let's assume that a crash is coming. No one can predict it in advance, but let's just assume. And you bought before the crash. What would that look like? So then I went through this process of what if a guy was saving and investing over 40 years and he just built up his money in his bank account, and every time the market was about to peak, he had the misfortune of putting it in the market. And I ran the numbers, and this looks better than I thought they would. The key was he put the money at the peak, the market crashed, but then he kept it in the market, right? In the 1973-74 bear market, the stock market got cut in half. He put in right before that, but he kept his money in it right before the 1987 crash, all these big, huge crashes. And I looked at the numbers once, and I thought, man, this is actually way better than I thought it would. I better run these numbers again, because that can't be right. And I looked at it again, and it's like, wow, this is actually pretty good. Some simple saving over time, increasing his savings, and he ended up a millionaire. And the IRR, internal rate of return he got, was like 8% or something, just from investing at these peaks. And it was like, wow, the whole idea of thinking and acting for the long term can smooth out even the biggest of mistakes, as long as you keep your money invested and let it compound.
I think that's so valuable, because maybe it is psychology where people feel like, okay, I can do this, and they're chasing the latest trend. And you're a brilliant guy. You know this stuff. You've researched the stuff and everything, but exactly what you said. So if you're investing in your 401k and you're doing your dollar cost averaging, you're okay. So we'll get into some things and we'll look at market history, but the simplicity part of it, and I heard you talk a lot about simplicity, and I just appreciate that. So I just want people to know it can be just that simple. And if you're staying the course, it works. You just heard it from Ben Carlson.
Yeah, and the point is, he would have done way better if he would have just dollar cost average. I also looked at what would happen if Bob actually timed the bottom of the market, and he would pile up all his cash, then the bottom of a really nasty bear market, and he puts it in, and you actually would have done better off just dollar cost averaging the whole way, as opposed to trying to time, because no one is good enough to time the bottom of the bear market. It's just like no one is bad enough to put their money at the peak. But you can just kind of simplify and put your money to work on a regular basis, and that takes away a lot of the strain and the brain damage from thinking through all these decisions.
Yeah, so true.
What was really interesting is when you did the math exactly, and I forget the amounts you used, it was a certain amount that he saved, but he would pile it up in a regular checking account, literally at no investing value. And then you did it at the top and at the bottom, and then as a dollar cost averaging math. And whatever the amounts were, I remember very vividly that at the end of this 40-year period, he had $1.1 million when he invested at the peaks only. He had $1.7 million when he invested at the troughs, where he had the biggest bounce up. But when he dollar cost averaged over the course of 40 years, he had $2.3 million. You would think with mental math that if you invested everything you had at the bottom, at the trough of every market, and perfectly timed the upswing or the bull, you would have more than dollar cost averaging. But that was not the case. And I had never seen anybody run the numbers that way. And you did this in your book, where the article only did the peaks, but you took it through the troughs and dollar cost averaging. And everybody needs to read about Bob. Everybody needs to understand Bob, because it is the best way I have seen to make the most exact argument for dollar cost averaging. This also speaks a little bit against lump sum investing in a way, because mathematically, if you have a lump sum and you throw it in, it's going to over time do better. But this is lump sums at peaks and troughs. What do you think about lump sum versus dollar cost averaging when you say have a windfall?
Yeah, it's interesting, because this is like a facts versus feelings kind of thing. And some people, if you show them the data, it makes sense to them and the light bulb goes off and they go, okay, I'll trust the data. But most people have the human emotions and they go, I see the data, but I still want to trust my feelings, because my feelings are going to get hurt more than So if you look just at the history of the stock market, 75 to 80% of the time on a 12-month forward basis, you're going to be positive. Most of the time the stock market goes up. Okay, so from a probability perspective, you would say if you have a lump sum of money from a windfall for some reason, or a bonus or whatever it is, you should just put it to work, because the odds are in your favor that it's going to be up 1 year from now or so. But everyone in the back of their mind has this thing that goes, yeah, but what if I put it in and then it falls? What if I personally cause the bad luck here? People are superstitious or whatever it is, so they go through this regret minimization thing. We do this with our wealth management clients all the time. We show them the numbers. Some people say, yes, I like the numbers. Just do it. Rip the Band-Aid off, put it in. I'm a numbers person. Most people look at it and go, no, it would be way more painful if I put the money in and the market rolled over and I see this big lump sum. So I would rather put it in over the course of 12 to 18 months or whatever it is, on a monthly basis or a weekly basis or quarterly basis or whatever it is, and spread my bets. And a lot of people, even with the data in the face, say, I don't care. Or maybe they break it up. I'm going to do half now and I'm going to do half dollar cost averaging. So the thing that we always tell people is just any of those options are pretty good. There's no bad options there. If you put it all in, you're probably going to be okay. If you dollar cost average, you're probably going to be okay. maybe you can take advantage of volatility or whatever you decide to do. Just write it down and stick with the plan. Because a lot of people will dollar cost average and they'll go, wait a minute, the market's going up. Should I hold back and wait to put it in for later? Or the market's going down. Should I put more in? It's like, whatever you do, let's just have a plan and then faithfully follow the plan. Because you can't base your decisions on what you think the future outcomes will be, because there's so many different forks in the road and paths that the market could take. If you knew what the market was going to do, you wouldn't have to dollar cost average or make these decisions.
It's really interesting to me that when talking to your clients and dealing with the math and emotions of a big, what they think is one-time decision, where the math is lump sum, the emotion is dollar cost averaging over forever so they don't lose out. And then the hybrid solution, do you often use that where it's like, okay, let's take half and throw it in, and let's over the next 3, 6, 9, 12 months, stick to throwing the rest of this money in so that we get it to work? What do you find works best with balancing the math and emotion of the average investor?
So think about it from the other perspective. There are some people who come to us with a windfall of, hey, I work for Amazon or Google, and I've got these huge RSUs because I'm an employee at the company. And I know I need to diversify out of it because my whole livelihood is tied up in the company. I want to sell the stock. But boy, what happens if I sell the stock and then it keeps going up? I'm going to kick myself. So a lot of times what we say is, why don't you sell half now? Lock in some of these wonderful gains that you've got, right? You've already won the game. And then we can slowly but surely diversify out with the rest of it and think about it in a tax-aware manner and all these different things. So it's the opposite of the dollar cost averaging, right? You're dollar cost averaging out. It's the same thinking. And most people do, because this regret minimization framework of, what am I going to regret more? Am I going to regret more if I sell the stock and it keeps going up? Or am I going to regret more that I hold on to the stock in hopes that it rises, but then it crashes? Then what do I do? And if you break it up, you're covering all the bases. You give yourself some more upside, but you're also locking in some of the profits. And so you don't feel bad either way. So it's like you're diversifying your choices in a lot of ways. You're diversifying your regrets.
Yeah, I'm kind of doing that right now with the lump sum, just going out of one fund, trying to go into another one. And I know better. I have this written down and I still have trouble doing it, but I'm going to do like you are suggesting, just pull the trigger, just do it. Because I know the history that the market is more likely to be up than it's down. And so this whole emotional part, it's really hard because I tell other people to do that, just like you do. So I'm smiling the whole time you're saying that. I'm like, that's me.
I have to do that too. I have to automate those things, because if I'm trying to use my own discretion for those things, it's really hard, because then you go, yeah, but what if I could catch like a 5% correction really quick? That's what you think. And that's why market timing is so hard, because you're constantly negotiating with yourself of, oh yeah, but what if this happens? And what if that happens? And then if it goes against you, then you go, oh geez, the market just went up 10%. I was going to buy. Now what do I do? Do I wait for it to fall before I invest again? It can play mind games with you.
Not to mention that all these things going on right now, we've got the war. It's almost like you can psych yourself into thinking the market has done really well so far with the war, but what if this happens? What if that happens? So it's like we just need to stop talking ourselves out of logical things, right?
What we don't realize is it's a battle between Homo economicus and Homo sapiens. It's a battle between our emotional brains or logic, and then the math. It's hard for me to believe the math that I'm fine. My emotions are taking time to catch up with the fact that the math says I don't have to work anymore, and that's part of a transition process. It's really hard as a typical human being to operate in the middle of a skewed bell curve versus at the tails. And if you want to operate at the tails, that takes a lot of steel. Just like you said, a gain can feel like a loss because you sold. And we are in this loss aversion thing where you have half of your stock left, say your Google, and half of it goes up, but you feel like you lost because all of it didn't get to go up at the same time. But this hybrid solution that we just talked about, and writing it down and automating it, are really the three basic steps to getting money into the market that you know you need to do, because the worst decision you can make is to wait, which is a decision, do nothing and stay out, because that's how you lose for sure. And we'll talk about that at the end. Another way that you stress tested the buy and hold, simple, long-term index investor approach to life was looking at something that's become a little bit more in the news, a little bit more front of mind. Just like birthing a baby, we forget the pain a year or two later and have another one. Inflation happened 50 years ago in a big way. We had the great inflation of the 70s, and I was 7, 8 years old then. It didn't really hit home to me that interest rates went to 18% and all this stuff that happened then. And inflation is becoming again, in a little way, really, compared to then, a fear that's in the forefront of people's minds. It's in the news, it's affecting how people think. And we're focused on the price of eggs and gas, but inflation is a much bigger beast than this. Modern day inflation isn't exactly what it was, say, pre-World War II. And you do a really good job in the book over 2 chapters, taking us way back and then bringing us up to what modern inflation looks like. Because our listeners and maybe the investors at large have not heard this story. Would you tell this story for us, please?
Yeah, it's interesting. And I think, speaking to the psychology of everything, when we had this high inflation hit in the early 2020s from COVID and the supply shock and all the government spending, I probably underestimated what the impact would be. And I think it had been so long since many a generation of us had never experienced sky-high inflation like this, right? Maybe you weren't around the 70s. And so to have it happen, I just think those price levels, it's something you see all the time. It's not something you can push into the background. I think the anger that it caused and the sort of resentment or whatever was really interesting to study. That's why I wanted to include inflation in the book, because it is this weird phenomenon that's new. And so if you look at the early 19th century, like 1800 to World War II, essentially, you'd have these huge spikes. And I talk about how it was all driven by the war. You'd have these huge inflationary bursts, and inflation would get really high. And then you'd have these deflationary busts, and you'd kind of go back and forth. And the economy was way more volatile back then. So there was way more recessions. The recessions now are way spaced out. Back then, you'd have a recession every 2 to 3 years or something. And you'd have this deflationary bust where prices would fall. Inflation is not good, but deflation is bad, right? So inflation is the lesser of 2 evils. And Peter Bernstein had this in one of his books. In that 140-year period leading up to World War II, the average inflation rate was like 0.2% per year. I think it was like 28% in total over 140 years, which is pretty crazy to think about. And again, you had inflation, it would be offset by the deflation. And that's changed in the last 80 plus years, where we've now had this sort of 3.5% annual inflation rate. And one of the reasons that we didn't have it before is because the economy wasn't growing as much. And so if the economy is growing and the sort of debt within the system is growing, you'd expect that inflation and prices will rise. So this is still a relatively new phenomenon, not unlike retirement. You mentioned retirement there. I like to remind people that retirement is a relatively new concept. It's not like we have multiple generations to look at for an example. That period I mentioned in the 19th century, people's retirement plan was you worked on the farm until you died, essentially, right? There was no 20 to 30 years of retirement and enjoying your money and living on the beach with a golf course or whatever. So that's still a relatively new phenomenon. So a lot of this stuff that we're dealing with, it's not like we've been prepared to deal with it. It's still a new phenomenon.
The history of it, where our economy was driven by frequent wars, was really interesting to me. And we don't see that necessarily, that impact of wars anymore. Why did things change post-World War II? What was different about this economic cycle that was driven by catalysts of war, where it became inflation and then deflation? What was the impetus that caused the difference there?
It was like the economy finally got on this track of longer term growth as opposed to these booms and busts. There's still booms and busts in the stock market, but there's not as many of these. They used to call them panics back in the day. They've actually changed the name to recession, I mentioned in the book, because panic and depression were just like too scary of terms. And for a long time after the Great Depression, people thought like there's going to be another one that's going to happen. It's going to come along because that's the worst one. But there was ones that were just as bad in the similar ballpark before. And I think what's happened is after living through those periods, we've learned that there was no financial backstop for anyone in the Great Depression era. There was no Social Security. There was no unemployment insurance. The Fed didn't really act as this like lender of last resort. The government officials actually made a lot of things worse during a crisis. And living through those periods caused all these things to happen. Now we have a backstop for people, right? The unemployment insurance during COVID kicked in and they even increased it. And so a lot of people were being paid just as much or more to stay at home. I think if that COVID period where we shut the economy off for a couple months and turned it back on, if that would have happened 40 years ago, we could have had a depression. But the government officials kind of learned, oh no, when something like this happens, we throw a bunch of money at it. So I think we've learned over time how to massage and manage the economy. I don't know what other risks we've created by doing that, but we're just a more mature, dynamic, diversified economy now.
Yeah, I think you make such a good point. I really never heard it put like that because a lot of us, when COVID hit, the market did drop fiercely in a short period of time. And we thought this was another Great Depression, all this stuff. But you mentioned all the reasons, all the things that are in place now, why that is not likely to happen. So should we not be worried about a depression-like era?
You never say never when it comes to the markets. There's no black and white. Everything exists in a shade of gray. I do think that the government officials have figured out how to take that left tail, that really outlier event off. Like the Great Depression was an 86% crash. The stock market is so much more important to everyone's well-being now because of the 401ks and the IRAs. And back then, I mentioned in the book, 2% of households owned stocks back then. Now it's 2/3 of all households own stocks. So it's so much more important. I think there would be anarchy in the streets if we let the stock market fall that much. I just don't think that we can't. But listen, this century alone, we've had 2 separate 50% crashes. So that's not like Great Depression level crash. In COVID, you mentioned it was a 35% crash. Still, those are big numbers. It's just not like this number that feels like the system is going to totally collapse on itself and come to an end. So yeah, we haven't outlawed stock market crashes. I think we've outlawed the kind of crash that can impact a generation for decades and decades to come.
Yeah, what I'm learning here is prior to 1940s, we kind of lived in all market weathers 25% of the time, whereas today with the Fed putting its finger on the scales, we live more in a growth market 70% of the time and deflationary or recessionary markets 15% of the time. If we look at the 4-quadrant model, they have their finger on the scale or their finger on the pulse in a way, which dictates what kind of portfolios we potentially need to diversify into, as opposed to say a 50-50. Maybe that's why a 60-40 or a 70-30 works, because we only need as many defensive assets that would cover the quadrants that we don't spend as much time in. And that's maybe a little bit more high level for folks, but that's the way I'm seeing it now, because it does dictate how we diversify moving towards the retirement. Now, with regards to inflation, we need to know how to combat it. And you talk about 3 major ways that we combat inflation that existed for some investors in the 70s, and people fear it. So what are the options to say, you know what, how am I going to hedge my bets against inflation if it's coming back?
Yeah, and I look at this from the perspective more of personal finance than I do investing. Because a lot of people will think about inflation and they'll say, what asset do I own that's going to hedge against this short-term burst in inflation? Should I own gold or Bitcoin? It's a tactic, not a strategy. I'm thinking more about from a high-level strategy, because there's going to be certain asset classes that do better or worse depending on what the inflation rate is, and it's hard to predict ahead of time. So I'm looking at it from a personal finance perspective, because it's funny, when you show someone, here's the inflation rate calculated by the government, it's 3.2% or whatever it is. Every household in America will look at that and go, you're wrong. This is what mine is because I spend on this and I spend on this. And everyone has their own personal inflation rate, because I spend on daycare. No, but I spend on transportation and I don't need a car, so I take this up. Whatever it is, your personal inflation rate is totally different depending on your spending needs and depending on your standard of living, where you live, all these different factors. So that's why it has to be a personal finance thing. So for me, number one is, I think, having a good job that you can increase your income, right? One of the things that happens during inflationary periods is wages tend to rise. They kind of go hand in hand, because one person's spending is another person's income. You want to have it so over time, your wages are growing at or above the rate of inflation. This is one of the hard things for a lot of personal finance people, because I think it's easier to give advice on saving and being frugal. And career advice, frankly, is hard to give. I get a lot of people who ask me for career advice. And if I tried to replicate my career in a Monte Carlo simulation, I don't know how many times I would fall on the same path I am on now, because there's so many different variables that go into it. Your network and who you know and timing and luck and all these things. But I do think your career, your income is a really big one. Diversifying your income streams, these types of things, to make sure that you can combat it. But the second one, I think, is you have to figure out your housing and your transportation. So I talk in the book that the BLS calculates this from all the spending in all households in America. Transportation and housing eat up 50% of the household budget for Americans on average. So if you don't have those 2 big pieces right, it's going to be really hard to combat inflation. And I think that's why a lot of people who already owned a house, who had like a 3% mortgage, weren't in as much pain as people thought they would be from the inflation, because the biggest expense in their life was covered with a low borrowing rate at a much lower price. And so when housing prices rose really fast and borrowing costs rose, people kept going, why aren't we going into a recession? Because the majority of the country who owns a home already had that piece locked in, and they knew what their monthly payment was going to be regardless. And so I think that has proven to be a really good hedge in periods like that. And then for the long term, stocks are still your best bet, right? Whatever period you want to look at over the last 50 years or 80 years or 100 years, the stock market has compounded at something like 5 to 7% over and above the rate of inflation. And that's because earnings grow faster than inflation and dividends grow faster than inflation. So the stock market still remains your best bet over the long haul to keep up your standard of living.
Yeah, but in the short term, we saw that, hey, in 2022, the stock market did really not keep up with inflation. And people that said that was like counterintuitive. I hold stocks to hedge against inflation, but it didn't work in the short term. It works in the long term because it takes a while for the market to catch up to the economy, right? They operate at different speeds.
Yes, exactly. And that's why you need to be a long-term holder in stocks, because you are hedging against inflation in those periods of high real returns before it ever happens. You're building up that sort of margin of safety. And I show in the book, that periods of rapidly rising inflation in the short run are actually bad for the stock market, which makes sense, right? Because it eats into the returns on equity for the corporations. And the stock market doesn't like higher inflation, especially like volatile inflation prices. It's stuff that's moving up and down really fast. Like corporations can plan for, even if it's a higher inflation rate, let's say it's 4% year in and year out, at least people can plan for that. But if it's going from 0% in COVID to 9% a year and a half later, that's harder to plan for. So the short term, the stock market can be bumpy for inflation.
So Ben, can we go back real quick to the job part of this? I'm thinking about 2025, where there was a lot of federal government workers that got laid off. And obviously, if you're a frontline worker, for instance, you could get laid off at any time. You're not the only one that's part of that formula. But you did mention having additional streams of income. So you yourself, you have your regular day job, but then you've got the podcast, you've got the blog, and you've got all these other things going on. So can you flesh that out a little bit more in terms of income as a whole versus just that main job?
Yes, I do think it's probably never been easier to have some sort of side income than it is today. And I get a lot of questions today about what is the impact of AI going to be on the labor market. I'm nervous because my job, I'm scared. I actually think, ironically, AI is going to see an explosion in business formation, because now you have all these tools at your disposal to help answer questions and start things. And you don't need all this technology and all this stuff to make it work. You have the ability to do these things on your own. And I think if people have the initiative and are creative enough, they can figure out ways to earn income on the side in ways that were much harder in the past.
Agree. I think that's really important, because back in the day, the job was the income. And today it's just completely different.
And that's where people have, in order to achieve FIRE, they'll have their day job in corporate America or whatever in the public service. They'll have real estate going. They'll have a small business going. Those are the three legs of the income stool in many ways. And you can escalate your journey to FIRE with real estate or small business, but there are higher risk and additional work or life energy that are involved in creating those. Let me circle back to the mortgage too, because the evolution of mortgages also played a role in mitigating inflation. When did the 15, 20, 30-year fixed rate mortgages come online? Because that became, as you said, a fixed payment that combated inflation, because you're paying for it with cheaper dollars along the way too. Those types of mortgages, because before, and it's almost like what Canada is doing now, you had to readjust or reapply for your mortgage every 3 to 5 years, and people have forgotten this. Tell us about the mortgage history.
It's kind of funny how much of today's modern economic world just really does date back to the Great Depression. And so there was a stat that I think 40% of all mortgages were in default during the Great Depression. And the government said, okay, we can't let these people lose their homes and go out of, what's going to happen? This really is going to lead to anarchy on the streets. And so what they did is, instead of these 5-year loans, and you used to have to put like a 50% down payment down, and then there would be a 5-year payment. And then after that, you either make a balloon payment for the rest of it, or you do another 5 years, right? But you're right. It was, what are the prevailing rates then? You're going to have to pay those. And a lot of other countries still have that. But the US said, all right, let's extend these loans. Because if the banks still need to have the payments come in too, because the banking system was in such peril. And they extended them first to 15 years, then 20, and finally 30 years. So it's funny, without that big financial crisis, we wouldn't have these 30-year mortgages. And I do think just one of the beauties of it is that it allows you to plan, right? Obviously there's ancillary costs that come with owning a home, right? The insurance and the property taxes and the maintenance and upkeep, those are real things. But with that monthly payment, which is essentially like your rent that you're paying down to your equity, you know what it's going to be year in and year out. And especially for the people who were lucky enough to lock in a low rate in the early 2020s, maybe that'll happen again, maybe not. But it's crazy that things ever got to that place where we had sub 3% mortgage loans, right? As a financial asset, the inflation rate now is higher than some people's mortgage rates, which is crazy. But yeah, that ability to extend the loan, obviously you're paying interest on it, but just financial planning perspective, it just gives people more wiggle room. And then getting back to the income piece, hopefully your income grows over time and it becomes easier to either pay it off or deal with it, right?
It becomes a lesser percentage of your expenses. And then people talk about extending these fixed rate mortgages to 40, 50, 70 years. There's a real danger in that because in some ways you want a paid off mortgage in a 30-year working lifetime. And I really worry about, in order to afford housing going forward and reduce the payments for this generation of folks that are renting, and first time homeownership is in the 30s, not in the 20s, how do they afford houses? There may be pressure to extend the rate of the lengths of these mortgages. What do you think about that?
Yeah, I like your idea that like the best thing about the 30-year mortgage is hopefully you get it to where you're paid off going into retirement, right? You have that debt off of your books and you're just sitting on the equity. I do think the 50-year mortgage is probably taking things too far, and hopefully there's better solutions to the housing crisis for young people, because it is really sad that we, through no fault of their own, a lot of young people just kind of missed the boat, right? If you didn't own a home before 2021, let's say, and prices rose 50% nationwide and interest rates rose, so you had this double whammy where things went from relatively affordable in most places to vastly unaffordable for a lot of places, and there's just not much inventory on the market anymore because a lot of people who have the 3% mortgages don't want to sell. Unfortunately, we really need to build more housing in this country, but it seems to be hard to get people on the same page to actually do that, and young people are the ones who are taking the brunt of it.
Yeah, and it's funny, the recency bias we had back in 2021, 2022, where there was 2.5%, 3% mortgage rates. I remember having that discussion with my daughter. She was a first-time home buyer, and I think it was like 3%. I'm like, oh, you might be able to get a little lower. And I realized how ridiculous that was. But she stood fast, and I told her maybe it's not a great time. The market will come back, or the prices will go down a little bit after 2021. She didn't listen to me, and she was the smarter person of that conversation.
See, she didn't try to time the market, right?
Yeah, she didn't try to time the market. Where she was in her life, it was her time, and it did turn out to be the greatest decision. We're not even in a high cost of living area where we see spike in housing, and it's already doubled easily. So yeah, just interesting how we have that recency bias with what's going on in the moment.
Yeah, it is weird that so much of your financial life can be kind of luck and timing, like your career.
Yeah.
So, which is, you have to control, you can control, right?
Yeah, exactly.
And what's interesting about inflation that you also said too is this whole loss aversion thing comes up again. You would think that when prices are going up, okay, you're going to buy less in the way of eggs or whatever, or cars or houses. And then people see inflation as a loss. And that is a double whammy. And what happens with that is there's no gain back because inflation really never comes down anymore. And so people have to readjust to these higher inflation when the prices adjust up and catch up, because it's almost like a reversion to the mean. There's this catch-up point with inflation, and the set point is there again, and the prices are set. They're not coming down. We're not going to see deflation. Just like the stock market, you've always got to dollar cost average in, regardless of inflation, to your housing and your cars and try and get them paid off. This is also a generation where I see those folks with boomer wealth are finding more and more that it isn't just college they need to help pay for, it's down payments for houses to get their kids into them.
Yeah, the loss aversion you're talking about is the idea that losses sting twice as bad as gains feel good, right? And so inflation is that sort of double whammy. I do think a lot of people had the misunderstanding when inflation spiked to 9% that like, we'll just get back to those 2019 levels eventually, without thinking through the other side of it, that you'd probably have to get back to 2019 wages as well. And no one wants to give up those wages either, right? So it is this psychological warfare with inflation. And I think the hard part is people can handle slow and steady stair-step inflation, right? Because we still had some inflation in the 2010s. It was just in the 1% to 2% annual range. It was easily digestible. But when you have this huge spike that's like the tide lifts all boats, that is the really hard part people have trouble dealing with.
Well, I appreciate your comments both on market timing and inflation. The story that people haven't heard in our generation really is the what about Japan story. And That is something that a lot of people just don't know about. And this is a piece of market history that is critical to understand because it's great education about massive bubbles, massive bursts, 3.5 lost decades. And you use this as a stress test of long-term buy and hold investing. And your conclusions at the end were really interesting. It's an argument in many ways for avoiding home country bias and for diversification in an international way, because this Japan bubble didn't really affect us and our markets, so it was okay for us to have home country bias. Countries have lost decades as an asset class, just like the S&P 500 has lost decades, or any other asset will have a lost decade, 2 or 3. They will come around again, but their market cycles are all different. Tell us the Japan story, because I found it fascinating, and your conclusions based on a 55-year long-term buy and hold.
Yeah, so this is the one I espouse a lot of long-term investing on my blog. And this is the one thing when people heard that story about Bob, they said, yeah, of course, but that was in the United States where there's this idea that the winners write the history books, right? So if you did that in the United States, of course, Bob turned into a millionaire. What if he did it in a place like Japan? And so a lot of people were giving me the exception. What if this worst case scenario happens? Then what do you do? And some people assume that because there are exceptions to the rule, in investing, there are exceptions to every rule, right? There's nothing that you can do that works every time, all the time. So that's just what you have to deal with, that sometimes things won't work out. You have to just shoot for high probabilities. But Japan was one of the biggest asset bubbles of all time in the 1980s. The stock market was trading for 100 times earnings, right? It was this massive bubble, and the real estate was in a bubble as well. The number was all the real estate in Tokyo, one city, was worth the entire real estate of the United States in the peak in 1989. So the pendulum swung so far in terms of greed and euphoria there. We've never really seen anything like that. And the returns were compressed for the stock market in such a short period of time. They essentially compressed 50 years of returns into 2 decades, right? Kind of what we did, not the same magnitude, but we compressed a decade's worth of returns in the housing market into 2 years or something in COVID, right? If you compress those returns, probably the returns from there aren't going to be as good, right? And so that's what happened in Japan. And so from 1990 till today, the Japanese stock market is up 2% per year, right? It went nowhere, essentially, for one of the largest developed economies in the world. But it was up 22% per year from 1970 to 1989. So they had all these returns in one little bucket. Now, if you actually stretched it out and looked at the returns since 1970, now we're talking 9% per year. So you have the one really high period mixed with the low period. And so what it showed is mean reversion. And we talked about luck a minute ago. If you just had bad luck in Japan, you had all of your money in there in 1990, you had a really bad outcome. But that doesn't show that long-term buy and hold doesn't work. It shows that you need to have a diversified portfolio. You can't put all of your eggs in one basket, because you're right, the rest of the world moved on just fine without Japan. Japan was the biggest stock market in the world in 1989, even bigger than the United States. And it went from 45% of the global market cap to 5%. And the rest of the world moved on just fine and didn't really bat an eye. And so that's the kind of thinking. That's why you want to have a more diversified portfolio. Why I'm a big proponent of international investing. Even though the U.S. has been by far the best place to invest in for the past 15 years, and a lot of people said, why would I ever put my money anywhere else? I don't look at diversification as a way to protect yourself against bad days or bad months or even bad years, but it could be just a bad long-term secular cycle like that. And that's the kind of protection you can get from diversification.
Yeah, what's interesting is, if you think about it, we've had 15 years of compressed returns in some ways. The last 5 or 7 years have seen a lot of 20, 22% returns. So is this in here? That begs the question, are we seeing the building of a Japan with this AI, big tech? Is it a bubble? People always ask, is this an AI bubble? Is history potentially repeating itself with these compressed returns and then mean reversion to lower returns? And then and with all of our recency bias, is fire at risk, is what some people say. What are your thoughts on this?
It is funny that the cycles of the stock market, these longer term cycles, and I'm talking 10, 12, 15, 20 years here. It's like an accordion where it compresses and then it expands, right? And so the first 10 years of this decade, the accordion was close together. And so we had a lost decade from 2000 to 2010-ish, right? The stock market went nowhere.
But when you say that, people need to understand that was the S&P 500. That was growth. That was an asset class in one particular market weather. Other asset classes that operate in other market weathers were doing just fine, right?
Yes, exactly. So I looked at it in the book, small cap stocks and mid cap stocks and international stocks and emerging markets and even bonds and REITs, all these other asset classes did pretty well when the S&P 500 lost 10% in a decade, right? You lost 1% per year in the biggest part of the stock market. And so I am of the opinion that there are no free lunches when it comes to investing, but diversification is pretty darn close. And so, yeah, you're talking about people who are fired or retired or what do I do with my money? I think diversification is more important than ever because sequence of return risk is such a big risk for you, right? If you're done saving and you're living off of your investments and you don't have as much income or time to wait out a bear market anymore. So that's when I think diversification matters even more than usual because you want to have these different streams of returns in case one of them goes wrong. And the point is, as a diversified investor, there's always going to be something you're apologizing for, right? And going, man, why do I own so much of that? I should own more of this and less of this. And then it changes. But you want to have something in your portfolio that's going to be able to see you through and give you some sort of margin of safety. If you do have one of those periods where one of your asset classes has lost decades, sure, I talk about that in the book, but even a period of 5 years or so will feel like an eternity if you have an asset that goes nowhere. And it can and will happen to something. That's why you want to spread your bets.
All right, so here, this begs the question that I addressed too. It's the lost decade, lost 5 years. Tell me your definition of diversification, because traditionally it's been stock bond diversification, 60-40 portfolio. But today, the modern investor has access to asset classes that do operate maybe better in other market weathers. You mentioned small cap value, you mentioned gold. You didn't mention trend following or managed futures. And then as far as bonds go, which bonds? Because people would say potentially bonds are dead now, just like equities were dead in the 20-aughts. And in many ways, when something's dead, it's cheap. And it's the time to diversify and buy. But people are believing in a 100% stock portfolio or bust through life, through retirement, maybe just a cash buffer in a barbell fashion. But let's go back, and I've asked a lot of questions. What is your definition of diversification? How has it changed over the years from Bill Bengen's original research to his recent research? And how have your thoughts evolved? How have you changed your mind as a wealth manager who's responsible for creating your clients' portfolios at this time and convincing them that this is in the boom years of growth, this is the best time at market peaks to diversify your bets, because having multiple asset classes is like having multiple streams of income?
Yeah, great question. I still think that simple trumps complex in a lot of ways. And I think there's never been a better time to be an individual investor. The strategies that are available to you with low costs and tax efficient wrappers like ETFs, in strategies that would have only been available to, say, like hedge fund investors or wealthy institutions 20 years ago. It is pretty nuts. The hard part is it's never been more tempting to try to change your portfolio and get a little bit of everything, right? Why don't I own some of this? And I should own some of this. And I think that temptation is hard too. So it does get tricky to balance out the simplicity versus the need to hedge something. And so the way we look at it as wealth managers, and I'm on our investment committee, is we like to diversify by asset class. We like to diversify by geography. We also like to diversify by strategy, right? And for some people, it also comes down to, do you need some sort of behavioral release valve, right? You talked about like trend following, or we employ a model like that, but it's not for every client. Some clients do have a steady hand, and if there's a correction or a crash, they can sit through it and they can rebalance into the pain and they're fine. Other people go, you know what? I have a way more mature portfolio now. I could sit through a crash when I was in my 30s, but now in my 50s or my 60s and I have more money, it's really hard to see this portion of my portfolio just evaporate. I actually don't mind the barbell portfolio you mentioned, as long as you think about it in terms of bucketing, like how many years worth of cash is it going to be, right? Do I have 3 to 4 years worth of cash in something that's whatever, a high yield savings account or T-bills or a money market? I think you just have to plan it out to give yourself a big enough margin of safety. If you're really going to let the rest ride on stocks and ride out that volatility, like, you do not want to be selling your stocks when they're down. That's the thing. You want to have enough assets so you have that margin of safety so you can let the stock market come back after it has one of those crashes or corrections.
You mentioned the barbell approach. I think I'm firmly in that bucket. I'm one of those fire people. I retired at 49. So you said make sure you have enough to live on. How many years would you say that is? For me, the number has been around 3 to 5 years, pretty much in a high yield savings account. I like to keep it simple. But from all the work that you do with your clients, how would you walk through that with your clients?
Thinking about it in terms of years makes more sense for most people than the percentage. You mentioned Bengen before. I've talked to him before too. I think that makes a lot more sense to me. So I had this guy reach out to me a number of years ago, and he said, I retired in March of 2000, okay, at the peak of the dot-com bubble. So he said, my wife and I retired, we were 55, and we possibly picked the worst ever time to retire because we lived through a 50% crash, and then the market came back, and then it crashed 50% again, all in the same decade. But he retired right before that lost decade. I said, okay, how did you do it? Because he said, we're still retired all these years later, and we made it. And I said, what did you do? He said, I have a 4-year rule. I always keep 4 years worth of cash. And that was his thing. And so I do that as the baseline. And then I think you take your own personal risk tolerance from there and go, some people say, you know what, the average bear market lasts 24 months or something. I only need 2 years. Other people say, no way. 4 years is not enough. I need 6. I think it's good to have baselines like that, right? Where you have some sort of starting point and then you adjust it for your own appetite for risk. Because in the book, I talk about there's 3 things that make up your risk profile. It's your willingness, your need, and ability to take risk. And you can kind of quantify your need and ability to take risk, right? Your need to take risk is, what do I need for my portfolio to reach my goals? What expected return do I need? Your ability to take risk is your financial circumstances. Like, where are you today? What's your net worth? What's your savings rate? What's your spending rate? All the numbers, right? So you can calculate both of those things. The willingness to take risk, that's the hard one. That's the qualitative, more squishy one, right?
Right.
That's the emotional. What's your sleep at night point? So that's a harder one. That's more of a personal answer. And that's more about knowing yourself and what is going to allow you to not only reach your goals, but do so in a fashion that's not going to cause you to worry all the time.
Okay. Yeah, that makes me feel better because when I said 3 years, 4 years, I thought you were going to say, no, you need 10 years.
But here's the question, Jackie, and there's data on this. At what percent of your portfolio is there significant cash drag where you're losing out potentially to inflation and market growth? The number I have learned from my research is 10%. So percentages are still important, not letting cash get away from you. And then we got to go to the bond question.
Yeah, it's interesting. So you mentioned the bond thing, and I didn't get to that. I think in the early 2020s, it's the first time people have realized that bonds are not this one decision thing anymore, right? You just put all of your money in a total bond index fund and you'll be fine. Put it in the ag, whatever it is, put it in 10-year treasuries. Bonds were kind of this one decision asset class for so long because for 40 years, we had a period of declining rates. So it really didn't matter that much what your portfolio of bonds were in. Rates were pretty good and yields fell. So you got a double whammy because bonds and prices are inversely correlated, right? When rates fall, bond prices go up.
But with bonds, we got to be specific because we're talking here about intermediate or long-term treasuries pretty much reliably over 100 years have been the bounce that people need in a recessionary environment. This isn't necessarily corporate bonds. It isn't necessarily tips. These two things are much more highly correlated with the markets, where correlation becomes critical in how you allocate to bonds. And people don't understand necessarily long-term treasuries. There's a lot of mental accounting and psychological bond investment with individual bond ladders of 3, 5, 8 years that are often proffered to clients because they understand that I'm protected. But then individual bonds and these ladders aren't necessarily, they're more complex than buying a bond fund. Take us through this bond question in a little more nuanced way because of the correlation issue and this ladder issue where functionally you're doing your own directly indexed bond ladder that is complex to manage. And then they don't realize because they're not marked to market, individual bonds do lose their value, even though you think I'm getting my principal back on the back end if I allow them to go to maturity. This bond question, I think, is a little bit more complex and nuanced than people think because they think they're dead. They think that they don't need them, when in reality, they could buy the dip, and they're cheap now to diversify. But it's the bonds they should be buying now are very specific.
Yeah, it is interesting because First of all, the thing that I like to say is that the book is called Risk and Reward. And I think that's the way that I like to think about investing in bonds. And so I like to accept my volatility where I'm being paid for it. And I don't think you're paid for accepting volatility in fixed income. That should, for me, that's the anchor of the portfolio. So investing in like these long duration bonds that can have really high volatility, I don't think it's worth it in the end, unless the rates are like abnormally high, right? And you're right. People have very strong opinions about the owning individual bonds versus bond funds, because guess what? A bond fund is a fund made up of individual bonds. It's the same thing.
Right.
So you're right. If rates rise and you own individual bonds and you go to sell them, you're going to be selling them at a loss, right? Just because you hold it to maturity doesn't make it any better. And so I think what people learned in 2020 was that as inflation rises and as interest rates rise, like maybe the diversification on my bond side of the portfolio has to change too. Maybe I have to be more thoughtful about the diversification there. And that could be, Jackie, like you, part of it is cash.
Right.
Part of it could be tips. And it's funny because I got a lot of questions from people in early 2020 saying, hey, I owned a TIPS ETF, the Treasury Inflation Protected Securities. Why did that lose money?
Right.
Because they were long duration and they acted like bonds and not a Treasury protected. So like it has to be short-term tips if you really want the inflation protection. And so I think you need to be more thoughtful about that fixed income side of things and maybe have some more diversification there. The great thing about owning T-bills or short-term whatever is that when interest rates rise, the short-term rates adjust really quickly, right? If the Fed raises rates, those short-term T-bills or high-yield savings account or CDs, they adjust quickly. But you're going to lose money if you have intermediate or long-term bonds. But you're right, Bill, that those in the recession scenario where rates fall and people like you have a flight to safety, then those can protect you. So I think you have to think through like, how do I protect against, you mentioned those different quadrants earlier. How do I protect against a rising rate environment and rising inflationary environment, but also a falling rate and recessionary environment, and then the in between? And so I think you need to be more thoughtful about that fixed income side of things. And it's not just a one decision asset class anymore for people.
Yeah, people don't understand the duration question here too, and how duration and losses are associated with interest rate rises or decreases, because it's a mathematical issue. Take us through what actually duration means and what a 1% increase in rates really does to a 3-year, 5-year, 10-year, 30-year bond.
Yeah, you're right. Bonds are more governed by math than stocks, right? It's not perfect because rates move and inflation moves. There are some mathematical relationships. So the idea is if you have a 5-year duration bond, and that's pretty close to maturity, the duration is effectively like when you're going to get all your money paid back to you with interest and principal together, right? So the duration is a little shorter than maturity. But what it says is that for a 1% move in rates, all else equal, how much is your fund going to rise or fall by? And it's not perfect because there's a difference between, I'm getting into nerdy stuff here, but sometimes it rises more than it falls or it falls more than it rises, but it would be like a 5% loss in your portfolio for every 1% move in rates, right? So if you have a duration of 15 years and rates go up 1%, you're going to be down 15%. So that longer term bond just has way more volatility, which makes sense because there's way more environments and changes that can happen over the long time than if you have a short-term bond. The duration is going to be much lower, and there's not going to be as much volatility there because you're going to get paid back pretty quickly. So the changes in rates and inflation don't really matter as much. So you have to really be cognizant of that because you don't want to get into a situation where, like in 2022, the bond market causes the stock market to fall, and now they fall together. And then what do you sell? Because the 60 is down and the 40 is down. So you want part of that 40 to be something that can be a shock absorber when there is rising rates and there is higher inflation.
That's where a cash allocation and a long-term treasury allocation, a barbell bond allocation may make sense because cash is a really good inflationary hedge. And how do you balance those individual components of a composite portfolio? Because you really want to know how it acts in a portfolio and not in isolation. And I really want people to understand that because there are asset classes when bonds and stocks fell that did go up. What were they?
Right. Yes. Yeah, you're right. Because it's, again, I think people kind of learned this lesson. Like we hadn't had that economic environment in so long that it happened. I do think a lot of people did realize, oh, actually this cash piece and this sort of T-bills makes way more sense as a piece of my portfolio, even if you mentioned over the long term, cash is going to be a drag on returns. But can it help me in the short term act as my buffer in my margin of safety for either when the stock market gets hit or when the bond market gets hit? So if you think about an ag fund, it has a duration right now somewhere in the 6 to 8 year range. So if rates keep rising, it's bad for it. But the good thing is, back to the mathematical part of bonds, so the bonds are yielding somewhere, high quality bonds, and we're talking treasuries again, are yielding something in the 4 to 5% range now. We've gone from essentially 1% to 4 or 5%. And that caused some pain for people who were invested in the bonds. But the good news is now your future returns are much higher because the correlation between the starting yield in high quality bonds and the future returns is like 0.95, meaning it's almost a 1-to-1 correlation of if you start at 5% yield, 5 years from now, your return will be pretty close to 5% per year. So that's the positive for bond investors. Now, there's a way bigger margin of safety now in the form of rates where you didn't have that in 2020 when rates were on the floor.
Yeah, and then, okay, I'm leading you down a rabbit hole here, and somewhat intentionally. In this quadrant of stagflation we saw where bonds and stocks fell, it seems to me that there has not been the beginnings of a lost decade in small cap value, gold, and trend falling. How have your thoughts on these three asset classes, given the lessons of 2022, changed?
It's interesting because if you did like a long-term correlation matrix of these, that's what we look at over time. It's not like these things are flat and the correlation stays similar. It goes up and down. The same thing with bonds and stocks, right? Sometimes stocks and bonds are correlated, sometimes they're not. I think I looked and 60% of all years, stocks and bonds are both up. So you don't necessarily just want something that goes down when something else goes up or goes up when something else goes down. And I think what you've seen from an asset like gold or small cap value or any of these ones that you mentioned is that sometimes they're correlated and sometimes they're not. And I think that's a good thing to have assets that kind of act like chameleons. And you mentioned like trend following. Same thing. It's like they act differently in different environments. And sometimes they save you and sometimes they don't. And I think that's a good thing is you want assets that can be complements in your portfolio. And that's why I think of this sort of wider diversification in terms of strategy, that you want to have those in your portfolio for when the times go bad. Because there are a lot of investors right now who think, what are you guys talking about? This is easy. Just put all your money in the S&P 500 or the NASDAQ 100. This is the only thing you need because this is the only thing that's working. And in a bull market, diversification does make you feel like an idiot, right? You go, why am I doing this? Why do I have these other pieces of my portfolio that aren't keeping up? I should have all my money in tech stocks. What are we doing here? The reason you do is because these things are cyclical. And that's the way that I view it. You want to have a portfolio that's durable enough to withstand a wide range of market environments. So you don't get to the point where you have to freak out when tech stocks eventually fall.
The rage now, there's a little flame burning in the FIRE community with regards to this term that gets because I've just led you down the rabbit hole of risk parity. Basically, the 4-quadrant model, risk parity, asset classes, multiple streams of income that operate in different environments. And people are starting to get curious about this. And there's a few people in this tail cult of risk parity where it's, I'm wondering, I'm feeling this concentration risk in 100% S&P 500 or total stock market and US bias. And then the lost decade is coming back up because the lost decade of inflation, the lost decade of Japan, the lost decade of the S&P 500, every asset class is going to have this. And if you're concentrated in that, you're going to have a lot of real trouble in retirement, especially if inflation strikes and things like that. So how much diversification is enough? What's the Goldilocks of diversification? It can be numbers of asset classes. And people say, I'm going to stick to a 1, 2, 3 fund portfolio, barbell with cash. And then in retirement, do you migrate to 4, 5, 6? And then if you get to 7, 8, 9, 10, is it too much? It is able to DIY a diversified portfolio of, say, 6 asset classes if you can do 3. So how much is too little? How much is too much? And which asset classes would you include in the transition from a growth accumulation portfolio to a wealth preservation decumulation portfolio?
All right. So my answer here is the perfect portfolio is going to be known in hindsight. So I'll tell you what the best one was from before. I guess the way that I look at it is, and I like that you're stress testing me because that was like the whole point of this book is stress testing your beliefs and how you think about investing. I believe that investing itself is just a form of trade-offs. And every financial decision is really. And I think diversification is the same way. Because if you get to the point where, I don't know if it's risk parity or something else where you have, 6 different buckets or 8 different buckets or 10 different buckets, whatever it is, the odds of one of those things doing poorly is probably increasing. So I think you're deciding the trade-off between I'm going to be ultra diversified for all these different quadrants and types of economic environments versus, man, it's going to be more complicated. And can I stick with it? And so I think that's the hard part for people, is understanding, like, if I add these different strategies, if it's gold or trend following or managed futures or some of the other things you mentioned, can I stick with it? And I think the hardest part for people is like having the understanding behind, like, this is what I own and this is why I own it. And I think the biggest test for most people is, if this asset is trailing, and in a diversified portfolio, something always is, do I have the intestinal fortitude to rebalance into the pain? And I tend to think that a simpler strategy is easy to rebalance to, or at least something that you understand. Now, some people, like you said, go down the rabbit hole and they understand each of these strategies and they know the pros and cons and they can rebalance in it. So I think that's the litmus test for this stuff is, are you going to be rebalancing it? Because gold has had a fantastic decade in the 2020s, right? It's beat the stock market. It's done really well, but it had a really terrible 2010s. And so if you're going to own gold, are you going to be willing to rebalance into it with your position in the 2010s period when it's doing poorly? Because that's how it pays off for you in the 2020s, because you kept rebalancing into it in the 2010s when it was lagging. And so I think that's just the question you have to ask yourself when adding these different types of strategies. Because there are people who just say, you know what, I don't care. I'm fine with the 3-fund portfolio. I can let everything else go. It's other people say, no, I want to be really well prepared for these other environments, and that's going to help me sleep better at night. And the truth is, there is no perfect answer. For as wealth managers, we have like our core models that we use for clients, right? Depending on their risk profile and all this stuff. And then we have these other levers you can pull, right? Do you need muni bonds? Do you need a trend following system? Do you need a momentum strategy? Like all these different levers. And it's up to our advisors to understand the clients enough to know, like, this person needs to pull all the levers, or this person just needs one of the levers because of their situation. And the unsatisfying answer is here, it depends. Like, that's the most unsatisfying answer in all of finance.
So, okay, so I'm going to add in an asset class that I think is critical when you start increasing the number of asset classes you want, streams of income, operating in different market environments. The asset class here is the advisor. And for me, that is the it factor. That's where you take your emotions out of the equation, your ability to rebalance into the pain, as you say, and that's exactly what I've done. As I've increased the complexity, diversification, because I don't have a business, I don't have real estate on the outside. I am dependent on my portfolio for diversification and streams of income and for it to operate in the lost decade or the bear market. And I know myself that I can't do that. There are people that can, and they exist in this, in the DIY domain. But if you recognize your own blind spots, your own problems with this strategy, that's when you really need the flat fee advisor that's willing to operate in a risk parity portfolio. And how do you sell these portfolios to these clients that have the need, willingness, and ability to take them on, but recognize that they need you to manage them?
You took a lot of the words out of my mouth there. It's about understanding yourself. And that's the biggest component for any investor, is like, what is the lesser version of myself? And what is my blind spot? What do I need someone for? For some people, it's just they need the expertise, right? Like, I don't have the time. I don't have the inclination to learn this stuff. Other people, they love this stuff, but they want to outsource because of their emotions. Or some people, it's, listen, I've been handling the portfolio for 20 years for my family, but what happens if I step off the curb and get hit by a bus tomorrow? I want someone to have my family's back or whatever. So there's a lot of different reasons that people do use advisors. The number one question almost every client who comes to us wants to answer is, am I going to be okay? If I make this decision, if I buy this vacation home, if I take my family on a cruise, if I make this change to my portfolio, if I go more conservative or if I go more aggressive, am I going to be okay? Am I going to reach my goals? And that's the biggest benchmark for everyone. And I think that's what most people want answered. My line of thinking is, there's a lot of different ways to be successful as an investor. I've interacted with thousands of investors over the years. No two are the same, and they've done it through different ways. I've met plenty of really rich index fund people and target date people. I've met people who are rich from stock picking and people who are rich from investing in real estate and all of these different things. There's many different ways to be successful. There's a few different ways to fail, and they're all similar.
And actually, I know we're going over an hour, but that's where I wanted to go next. And if you invert, according to Charlie Munger, and how do I not live a regret-free life? That's the 5 regrets of the dying. How do I fail at investing? And there are very common, I think you gave 5. Let's tell, and how do we learn from these mistakes? What are the most common ways people will fail so that you know these are the traps?
Yeah, so I kind of go over it in the book a little bit, but with one of them we talked about here is just constantly trying to time the market. I think it's just really hard. And I think part of that is getting down to pretending you're smarter than the market. And I see this all the time with people who are really smart in one domain and think it transfers into the market, right? Like working with doctors or engineers or lawyers.
Like,
People who
exactly.
have had a lot of education, they think there's, so I think timing the market and pretending you're smarter. I think the biggest one, there's fighting the last war and chasing performance and all these things and paying too much attention to the short run. But I think the biggest one is just giving up on your plan or not having a plan, some sort of plan you can follow in the first place. And if you look at someone like Warren Buffett, that's maybe one of the most impressive things that he did is just 60 years or whatever as an investor. He kind of just stuck to a similar plan the whole time. The kind of stocks he bought maybe evolved over time, but he didn't change his stripes in it as an investor. And I think that's one of the things that is the most important is just, can I stick to this plan, whatever it is that I've come up with, come hell or high water? And I really do think that perfect is the enemy of good for most people in trying to over-optimize and not just find something that it works for you. I think that's the big thing.
All right, Jackie, I'm sorry I have dominated the questions because I was trying to tap in Ben's mind here.
I know you're very interested in, Ben.
And the message here is really long-term buy and hold investing over whatever term you look at and whatever worst market cycle does work. He's proven it does. This book is excellent and every investor should read this. There are other lessons to be learned here. And he closes the book with these 10 things or whatever that you can absolutely lose money in. And I've done them. I've done a few of them. I've learned the hard way with trend following, recency bias, all this stuff. And then he talks also and closes the book with 10, 20 things you need to believe about investing. We obviously can't go through them, but at the end, he brings it back to simplicity. And he wants every investor to ask themselves 2 questions. And Ben, let's bring it to a close here with regards to what are those 2 questions that we just need to ask before we make our plan?
Yeah, so I think every investment decision boils down to when am I going to need the money? So that's your time horizon. And then how much can I afford to lose in the meantime, either financially or psychologically, right? What's the volatility that I can handle personally? What's my appetite for risk? And those are personal questions.
Yeah, it's just that simple. If you couldn't tell, Ben, I'm the simplicity girl over here, and Bill likes to get deep into it, especially with the bonds and things like that. But it's definitely worth listening to. So why don't you tell us, you have so many platforms where you are sharing this wonderful information. We talked about your book, Risk and Reward, and that's available everywhere, right? So what are the other places people can, I guess, tap into your mind and your thoughts and your whole ideas about the markets and more about what we talked about today?
Yeah, wealthofcommonsense.com is my blog. You can sign up for my newsletter there. And then Animal Spirits is the podcast where we're constantly chopping up about markets and personal finance and what's going on in our lives.
Yeah, I don't know how you do all that you do, quite honestly, and help clients at the same time. You're one of those guys that seems to have a clone and works 25 hours a day and 8 days a week. I am a religious reader of your blog. I'm a religious listener to your podcast. I think these are excellent resources for the investors, both beginner, intermediate, and advanced. You do a great job with that. And I want to also leave folks with, we've talked about simplicity and complexity, and this has been such an excellent conversation, but people constantly compare themselves to others. And then you talk about the only benchmark for your investment progress is, are you on track to reach your own individual personal financial goals? What is your plan? What are your strategies? Do you use an advisor or not? Do you use a little bit more complexity and diversification in retirement or not? Make a plan, stick to the plan, come hell or high water, be a long-term investor. It's really very simple, but it's also very personal. There are some universal things like savings rate that dictate a lot. And you can set the time of retirement by setting what we like to call a lifetime savings rate. And people need to reverse engineer that too, because the market is not magic. It's not going to necessarily get you there any faster. There are definitive time horizons that you will get to time freedom if you set it and forget it with regards to savings rate too, in order to buy back your time to fire freedom whenever you want, 50, 55, 60. I think this conversation has covered, it may be the top one of our podcasts that everybody needs to listen to. You've been fantastic in being transparent. And I just appreciate all the knowledge that you bring to bear here. Everybody needs to read the book. Everybody needs to listen to the podcast and read your blog. They will become excellent long-term investors if they do. Thank you, Ben, for being here today.
Thanks both for having me.
Just always remember, it's never too late to start. It's better late than never. And it's always the right time to catch up to 5.
Thank you, guys. We'll see you next time on Catching Up to 5.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. And our editor is Fritz Brazard. We love them and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofy.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to 5. Cheers.